So the agenda for today, I'm going to break it up into 3 parts, starting with the key features of the VCC. And secondly, I'm going to compare between the VCC and another well-known structure in the region, the Cayman SPC. Lastly, the VCC is being touted as a game changer. So what's the hype all about? How can we make use of VCC to our advantage? Let's begin. Key features of the VCC. VCC is a new corporate structure launched on the 15th of January 2020 by the Monetary Authority of Singapore, MAS, and the company registrar, what we call the ACRA in Singapore. The addition of VCC to complement the existing suite of fund investment vehicles is key to increase Singapore value proposition as an asset and wealth management hub, both in the region and globally. By introducing a number of special features, this customized corporate structure will overcome the shortcoming of existing company law aspects, which I'm going to talk about in the next slide. Next slide. The challenges of company form fund. Before we go into the VCC proper, let's take a step back to understand why Singapore had to do this. Singapore, as a country, offers a wide range of fund investment vehicles in the form of limited partnership, unit trusts, private limited companies, real estate investment trusts. So why VCC? What are the current challenges? Number 1, the lack of variable capital structure. The Singapore Corporation are vehicles with fixed capital. Typically, an investment fund should offer the shareholder the freedom to invest in or out of the structure through subscription or redemption. The notion of the variable capital provision is critical to the operation of the investment fund, which today, under the Singapore Corporation Act, being a fixed capital structure doesn't allow. Number 2, solvency test. Funds set up as corporation are required to go through a solvency test before any repayment of capital. And this is a hurdle and can be proved challenging administratively. Number 3, privacy issues. The shareholder list for Singapore corporations is publicly available. I can go to the Singapore Company Registrar, the ACRA website. I pay a small fee. I can download the shareholder list and see everything in it. Privacy is very important in wealth management, and you wouldn't want to let everybody know what you've got. Number 4, classification of redeemable shares. Singapore funds are usually classified in the form of redeemable preferred shares. This can be a challenge when solvency tests are conducted before any capital redemption. Next slide. What is a VCC? A VCC is a new legal structure providing for investment funds to be domiciled in Singapore. It is incorporated under the VCC Act and not the Companies Act. Therefore, its aim is to provide an alternative to existing fund and collective investment schemes, such as unit trusts, partnerships, corporations, etc., to overcome the challenges described in the previous slide. Number 2, a VCC can be used as both open-ended and closed-ended fund, and it is flexible. It is suitable for a wide range of investment strategies. Now, let's look at the key features. Number 1, stand-alone or umbrella fund. A VCC can be set up as an umbrella structure with multiple numbers of sub-funds. There can be as many sub-funds as you could. You can also have both open-ended as well as closed-ended sub-funds in one umbrella structure. You can also have different regulated regimes for different sub-funds under one umbrella structure. You can have the flexibility in structuring and administering. For standalone fund, having one shareholder allows for a master feeder structure, which I will explain later. For umbrella fund, each sub-fund can pursue its own investment strategies. Next slide. Segregation of assets and liability. For umbrella fund, as mentioned, you can have as many sub-funds as you want, each with its own mandate. And each of the sub-fund will be ring-fenced. So whatever happens to sub-fund 1 will not affect sub-fund 2 and 3 and 4. However, it is the duty of the board of directors to make sure there's adequate checks and balances in place in the operation. And VCC as a whole is considered as one company, one legal entity. Depending on your strategies, these features can be extremely useful. Next slide. Flexibility in share capital. I'm going to spend a bit longer on this slide because this is ultimately what the investors invest in. And the share capital is always equal to net asset value because the VCC measures the assets and liability at fair value at every point in time. Therefore, whenever distributions are made, it is irrelevant if it's made out of income or out of capital. And you define the rules of your game. In the constitution, you may decide how the distribution will be made and from which pockets, whether is it from income or from capital. You are free to do so in your investors' communication. There's no statutory declaration like there is in the Singapore Companies Act. You have to issue and redeem shares at net asset value. This can also allow you to incorporate some kind of charges. For example, if you want to include the redemption fee, the front-end load, the back-end load, it is allowed as long as it starts off from the NAV of the shares. You can go in and out through redemption in kind, not necessarily in cash, and switching is allowed between the sub-funds. A VCC may also issue different classes of shares with different rights and dividend payment, as long as it's stated clearly in the VCC constitution. And lastly, there's an imposition of a fair value. The fair value doesn't mean you have to appoint an external party for measuring the fair value. You can even do so as long as it's not from the people who are doing the investment transactions. Next slide. Flexibility with the corporate structure. As mentioned, no solvency test before any repayment or redemption. A VCC is able to issue and redeem shares without having to get shareholders' approval. This allows investors to exit their investment as they wish, providing a much needed flexibility. Next slide, please. Privacy. As mentioned, the VCC is registered with the ACRA and not the regulator. It's with the company registrar and not the MAS. Other key features, such as the wider scope of accounting standards to attract foreign funds. Except for retail VCC, which uses the Singapore Rep 7 accounting standard, financial statements for the VCC can be prepared using the SFRS, the IFRS, or the US GAAP. As well as the 13R and the 13X tax incentive can be extended to VCC, which I will share more later. And also, the check-the-box election is very attractive for US investors. For funds that have US investors, the key benefit of the VCC is it is eligible for the US check-the-box election, which allows a fund to be treated as transparent for the purpose of US federal income tax. This means that any US investors is placed in the same tax position as if they had invested directly in the underlying investments of the VCC. And lastly, there are two ways to set up a VCC. Number one is to incorporate a brand new VCC. And number two, you can also re-domicile your existing fund from overseas to Singapore. And to attract the overseas fund to set up the VCC in Singapore, we have already made these features very streamlined and the process to be very efficient. Next slide. So far, I hope the features of the VCC are clear and how they have overcome the challenges posed by the Singapore Corporation in the past. And I would like to emphasize here that the features of the VCC is not any different from what we are used to in an investment fund, which can be located in Cayman Island, Mauritius, BVI, Luxembourg, Ireland, etc. Why we are breaking down these features into various pieces? Because once you break it down, you understand the features of the VCC, you're able to make mental notes, how you are able to use it for your own investment structure. Which I'm going to talk about shortly. Next slide. To set up a VCC, you need to invite these people into the party. Number one, you need a fund lawyer to draft out the legal documents. Number two, you need a Singapore-based fund administrator to calculate the NAV, etc. Number three, you need a fund auditor. And also you need a company secretary and you need to have a registered office in Singapore. But lastly, you need to be licensed as a fund manager. And if you are not exempted, you need to work with a licensed entity which I'm going to talk about in the next slide. Who can set up a VCC? A VCC must be managed by a fund manager licensed or regulated by the MAS unless exempted. And under the fund management regime in Singapore, there are two main exceptions from holding a separate capital market license. Number one, the financial institution. It can be a bank, the commercial bank, merchant bank, whatever, or it can be an insurance company. They are regulated by the MAS and they are exempted from having a separate fund management license because as part of their business, they are already making investments. So they don't have to have an additional license just for fund management. And number two, if you are making your own money, managing your own money, your own proprietary assets, you don't need a separate capital market license. And out of these two, a SFO cannot launch a VCC. But that does not mean that SFO is excluded as an investor class from launching a VCC. If a SFO finds the VCC useful, they can get themselves licensed as a fund manager to launch it, or they can look for another fund manager in the marketplace, like Raffles Family Office, who hosts the Capital Market Services license to launch a VCC. Next slide. Now, after stating all the hard facts about the various features of the VCC, let's look at how we can utilize them. And over here, I'm not going to share how fund managers like myself can utilize the VCC. I'm going to share it from an investor point of view, since most of the attendees here today are investors or single family office. Next slide. One word of caution here, you have to consult your legal and tax counsel before constructing a VCC. Number one, you can use it as a wealth management consolidation. Over here, you can see there are 4 different high net worth individuals investing in 4 different asset classes. A VCC can organize separately managed accounts into umbrella VCC structure and offer similar or variety of terms to investors. The flexibility of pooling investors into a structure like a VCC would then widen the investor base by lowering the minimum entry level. If you are aiming for the tax incentive, which I'm going to talk about later in the presentation, having a VCC structure can significantly lower the minimum entry level and costs. The pooling of investments and managing accounts collectively will lead to cost and operational efficiency. Next slide. Secondly, the ability to pool investors and organize them in different combinations and sub-funds give investors the flexibility to pursue a different mix of different strategy. Over here, instead of having 4 different individuals as described earlier, we have one super ultra high net worth individual or one single family investing in different asset classes. Organizing these investments into an umbrella fund structure allows for consolidation and having a better overview of the investments. Next slide. Private wealth planning. As mentioned earlier, a VCC overcomes the current limitation of the Corporation Act when used for investment funds. Therefore, it provides enhanced offerings to high net worth individuals, boosting Singapore's value propositions in the private wealth industry. On the left, before the 15th of January 2020, a Singapore company is typically used to hold assets under a Singapore trust. That Singapore corporate will then apply for a tax incentive known as the 13R or 13X. Number one, there are limitations such as privacy. Shareholder lists can be downloaded and exposed, allowing anyone to download from the ACRA Singapore website. Number two, you cannot compartmentalize a Singapore corporation into different parts, like in the umbrella fund. And number three, every time you withdraw a capital, you need to conduct an solvency test. This can be a burden. And above all, you have to ensure the capital structure is properly developed so that you will not get into complication of redeemable preferred shares, which will have implications in the solvency test. After the 15th of January 2020, on the right, if you replace the Singapore Corporation under the Singapore Trust with the VCC, which is required to apply for the 13X or 13R on an umbrella level, but this is only a one-time application. And you can do away with all the noises that the Singapore Corporation comes with it, as mentioned earlier. The additional features is the creation of compartments or sub-funds, which allow you to put your different assets across different beneficiaries under one umbrella, or allow you to manage different asset strategies under one umbrella structure. Next slide. Tiered structure. Creating a VCC as an umbrella allows pooling of investors in broad categories of asset classes, which can then be properly allocated across further investors. Such pooling will improve the efficiency by removing the additional administrative layer across different fund structures. As you can see, in this tiered structure, the umbrella VCC structure can be used to facilitate economies of scale in dealing with a collection of segregated sub-funds, while allowing some flexibility in the allocation between the strategies to be provided to investors in a tiered structure of a umbrella VCC. As you can see on the top, the investors hold shares in sub-funds in VCC1, which invests into the sub-funds of VCC2 in various amounts. The VCC2 sub-fund allows segregated dealings in the different asset classes being invested. In this example, long equity, short equity, and bonds. The VCC1 sub-fund allows for different allocation into the underlying investment strategies through variation in the amount each of the VCC1 sub-funds hold in the VCC2 sub-fund. Next slide. Master feeder structure. So a VCC can hold a single investors and hold a single asset. So this provides the VCC the ability to have a master feeder structure, and this structure can be based in Singapore to accommodate US investors, for instance, that are taxable or tax exempt. To hold assets in other markets to allow investors to access different fund domiciles that are normally restricted due to regulatory regimes, for example, the UCITS or the AIFMD. For example, a US resident or investors, the VCC has the feature that will enable the check-the-box election. Investors will put capital into their respective feeder fund, which ultimately invests assets into the master fund. The master fund is responsible for making all portfolio investments and conducting all trading activities while managing and perform, while the management and performance fee are paid at the feeder fund level. Next slide. Now, after stating all the features and the usage of VCC, let's do an apple-to-apple comparison with the Cayman SPC. Across the board, VCC and SPC are very similar, but there are some differences. Raffles Family Office is one of the first 18 to launch the VCC on the 15th of January. And as part of the pilot program, we were asked by the MAS for our feedback on the structure. And I think it's important that we do not create a completely new vehicle, which the industry is unfamiliar with or will take a long time to get used to. Over the next few slides, we will compare the VCC with another corporate structure that is popular in this region, using Cayman as an example. VCC is categorized into two main categories. Number one, the authorized VCC, which is for the retail investors, the men on the streets. And secondly, the restricted VCC for accredited investors and exempted for small offering, private placements, and investor schemes. In terms of the legal framework, it's more or less the same, just using different authorities, using different names in different countries. Next slide. From governance point of view, for restricted VCC, you need to have one executive director and at least one independent director. For Cayman, only one director is required. And for authorized VCC, for the retail investors, for the men on the street, you need 3 directors for obvious reason. For Singapore VCC, the director must be a resident of Singapore. For Cayman, no such thing. And the director independent depends if your VCC is for the men on the street or not. So if it's for the men on the street, you need to be independent, whereas for the restricted or exempted VCC, there's no need. And lastly, the fund management director is not required in Cayman. In Singapore, yes, it's required. So next slide. Fund management. The location of fund manager has to be in Singapore for the VCC, because the whole point of this is to attract the inflow of funds into Singapore to boost the Singapore ecosystem. For Cayman, no such thing. It can be anywhere in the world. Both do not have a minimum capital to start, although there's no minimum capital to start because of the cost associated with setting up of the VCC. As I mentioned earlier, you need to have a lawyer, you need to have a fund administrator and a fund auditor and corporate secretary. There will be costs involved. And altogether, depending on your investment mandate and depending on the complexity, it will cost between around 50 to 80K if you are setting up a sub fund. So if your fund size is only about 1 million US dollars, you can still do it, but it wouldn't make much sense. And both allow for redomiciliation. VCC is a Singapore resident body corporate, which means it's entitled to 86 double taxation agreement that Singapore has. And in Cayman, no such thing. And this is, I believe, one of the strong advantage that the VCC has over the SPC. And there's a need to file tax return for the VCC. Cayman, no, because there's no such concept in Cayman. And check the box selection, both are applicable. Next slide. From accounting point of view, as mentioned just now, because Singapore wants to attract the foreign funds coming in, so that's why besides the Singapore accounting standard, Singapore financial reporting standard, we also allow the international financial reporting standard and the US GAAP. And you need to have a financial statement at every sub-fund level. Yes. And financial statements are not publicly available. The VCC financial statement has to be filed with the company registrar, the ACRA, and not the MAS. Whereas for Cayman, it's been filed with the CIMA. The segregation function of the assets and liability of the VCC is much stronger, but comparable to the SPC. And as far as taxation is concerned, VCC are liable to tax, must file tax return at the end of the year, whereas Cayman are tax exempt. Next slide, please. VCC requires a Singapore company secretary to be in Singapore, whereas Cayman doesn't need a company secretary, but needs to use a registered office in the Cayman Island. For the VCC, fund administrator has to be in Singapore. For Cayman, only for administered fund, a special category of fund in the Cayman Island has to use a Cayman fund admin. But 90% of the world uses the non-administrated funds. And if the fund is not a PE or a real estate, VCC requires a custodian, but it can be anywhere in the world as long as it's regulated as a custodian in that jurisdiction. In Cayman, no such thing. For VCC, auditor has to be Singapore-based and use a Singapore-based accountant. Cayman requires an auditor to be based and registered in Cayman. Next slide. And finally, for VCC, you can list. There's an ability to list. And AGM, not necessary. And it's not necessary to have the AGM. Yep. Next slide. So the key takeaway is, as you can see, the Singapore VCC and the Cayman SPC are not very different. Therefore, it is not a new vehicle and something that we are not familiar with as a body corporate structure. Setting up a VCC will enhance the localization and thereby the ecosystem of Singapore. And having a structure in Singapore, you don't have to get up in the middle of the night to attend a board meeting or leave a country to attend a board meeting of a Cayman fund. Therefore, it enhances the efficiency and economics of running the structure in Singapore. The hype surrounding VCC. 1 month ago, I was informed that 41 VCC have been set up. And this is a remarkable take-up rate considering today's investment climate, and VCC only started 4 months ago. So after setting all the key features and after comparing with Cayman, which is also very similar, what's all the hype about? Is there still a ground for Singapore to stand in this crowded and competitive fund management industry? Next slide. As the second Minister of Finance, Ms. Indrani Raja, said, the introduction of this corporate structure, known as the Variable Capital Company, or VCC, will be a game changer for Singapore's fund management industry. Singapore is already widely recognized as the most stable and well-run investment center in Southeast Asia or in the world. And the VCC will propel Singapore to global investment scene as a true competitor to the likes of Cayman Island and Luxembourg. Singapore has long relied on the fundamentals of a transparent economy, low corporate tax structure, political stability, and efficiency to maintain its investment appeal. While these have served Singapore well, it was still missing a flexible investment structure like the VCC. And how will VCC change the game? Next slide. VCC is not for everyone. Again, I'm breaking up into 3 different categories of people that will benefit from the VCC. Obviously, you benefit the local providers and fund managers like myself, because if the take-up rate is good, we will have more work to do. And if the ecosystem is successful, Singapore will benefit. But today, I'm going to share how it will benefit the investors like you and your clients. Next slide. Benefits for investors. As described in the earlier features, overcoming the challenges of a Singapore corporation can be deemed as an advantage. Number 1, all sub-funds are insulated from one another, which means one insolvent sub-fund cannot affect other sub-funds. This should provide peace of mind for investors. Number 2, a VCC is a corporate or legal entity. This means a VCC is able to act for or on behalf of itself without the need to appoint a trustee, offering much more freedom than a unit trust. A VCC is also able to issue and redeem shares without having to get shareholders' approval. This allows investors to exit their investments as they wish, providing much needed flexibility. Number 4, privacy, because the VCC shareholders list does not make public. Number 5, an AGM can be dispensed. And although the AGM is required in principle, the VCC does not need to hold an AGM if it decides not to. Therefore, for passive foreign investors, this can be a huge convenience. Number 6, if a VCC has sub-funds, those sub-funds can share the board of directors, as well as using the same service providers such as custodian, fund administrator, passing down those savings to the investors. And you will make the VCC very cost efficient. Number 7, because the VCC can have a single shareholder to just hold a single asset, it can be used as a master feeder structure for favorable pass-through tax treatment. Number 8, income from eligible VCC fund may be tax-free if they qualify for the 13R or 13X, which I'm going to talk about in the next slide. Next slide. Why 13R or 13X? And one of the very frequently asked questions I get here is, why do we talk about tax incentive? Many people have asked me, since the structure in Cayman and BVI are similar, why Singapore? My answer would be, if you manage those structures, if you manage those offshore structures from Singapore, and you take all the decisions from Singapore, having those structures in Cayman will still be subjected to Singapore tax. And that's why you have to consider tax incentive to get protection on those structures. Additionally, in 2019, Cayman introduced the Economic Substance Law, and in 2020, Cayman introduced the Private Fund Law. Therefore, having an economic substance is critical here. Next slide. Comparison between 13R and 13X. Basically, for 13R, the legal form and location has to be a Singapore company or a VCC. It must be managed by a Singapore-based fund management company. There's no fund size requirement. There are certain investors restriction, but if the fund is owned by individual, you must satisfy the investor relation. There'll be at least over 200K Singapore dollars business spending on the fund level, and you need to hire one investment professional, and you get one employment pass for that if you decide to hire a foreigner. For 13X, there's no restriction on the legal form and location. So the fund can be in Cayman, BVI, it can be a trust, it can be a Singapore company, it's your choice. But there's a minimum 50 million Singapore dollars at the point of application and 3 investment professionals. Because of the 50 million and the 3 investment professionals, MAS has removed the ownership restriction, so you can have a more flexible structure possible. The 200K local spending is also on the umbrella level. And one of the frequently asked questions here is, can the VCC gain PR status in Singapore? And my short answer is no. If you want to have a straightforward route, you need to consider the Global Investor Program, the GIP program. But this is not the agenda for today's seminar. You can apply for the EP, but after applying for the EP, you can apply for the PR. But that will still be subjected to approval from the ICA. Next slide. As shared earlier, before the 15th of January, one client has to set up a fund, and apply for the 13R or 13X, absorbing all the costs by himself. After the 15th of January, if you set up an umbrella fund structure, if you set up a sub-fund underneath an umbrella fund structure, there will be economies of scale. Next slide. So now let's look at why the 13R umbrella tax exemption is critical here. Why the tax incentive applying on umbrella level is better than on the single company level. On the left, okay, you can see that for the 13R, there is a shareholder or ownership restriction, which means that investor in the 13R fund is split into the so-called good or bad investors. And one of the categories of bad investors is Singapore corporate investors holding more than 30% of the 13R company. So on the left, you can see the Singapore corporate investor owns 40% of the 13R company. The rule says that if a Singapore corporate investor has more than 30% of the 13R company, the Singapore corporate investor is a bad investor, otherwise known as the non-qualifying relevant owner. And he has to pay a penalty. And the penalty is 17% on his shares of the profit of 13R company. On the right, you see that if the same structure is created using the VCC, you can create a VCC with 2 sub-funds. You can see that on the right, the 40% owned by the corporate investors actually becomes 20% as a whole, which is less than 30% requirement. And therefore, the investor turns to a good investor, which is not liable to the penalty. This shows that how the using an umbrella structure can work to your advantage rather than using a normal company to set up a 13R fund. Next slide. Now let's look at the 13X umbrella tax structure. So if you set up 4 13X funds as normal companies, you will need 200 million because the minimum is 50 million to start. And compare this with this 13X VCC and 4 sub-funds. 50 million on umbrella level and not on sub-fund level, and 200K business spending on umbrella level instead of 800K. And once you apply for the 13R tax incentive application, there will be no fresh application required for new sub-funds. Therefore, this can be served as a plug and play model if you decide to work with a fund manager who already has a VCC umbrella up and running. Next slide. Application of tax exemption timeline. In short, the whole process will take about 6 months. Number 1, you need to decide on the fund structure. Number 2, you need to do some housekeeping in terms of the regulatory aspects. Number 3, you will meet the MAS. MAS will conduct an interview, and today is in the form of con call. And after that, you get what we call the MASnet ID. 2 to 4 weeks later, you get the MASnet ID. And when you get the MASnet ID, you can file for 13R and 13X. Everything is done online at the moment. And once you submit the 13R and 13X application, you'll be approved between 8 to 12 weeks. And in today's climate, it might be take slightly longer. And after that, once it's approved already, then you have to, then you are able to launch your fund with the tax incentive. So over here, one of the frequently asked questions is, do I need to have the investment professionals ready before they file the application? And do I need to have the investment mandate agreement executed before I file? Both answer is yes. For the 13X, do I need to get 3 full-time Singapore-based professionals? Yes, they have to be based in Singapore, but of course they can travel for work. And do note that all the text that we are talking about is talking about economic substance here. But over here, there will be a bottleneck. Number one, time is of the essence. 6 months is a long time. We have met clients who decided to go it all alone instead of coming into under an umbrella. And 6 months later, after getting the 13R tax incentive, they don't know how to proceed due to the lack of know-how of how to operate a fund. And of course, if you do not have such a huge AUM, it doesn't make sense because there will be diseconomies of scale. So I have 6 more minutes. Before I end the presentation, I hope you find the features of the VCC useful, and I certainly do. And looking at the take-up rate in the past few months, the outlook is very rosy. And I'm going to share how to set up a VCC. There are 2 ways to set up a VCC. Number one, incorporation. Firstly, you need to do a bit of housekeeping. Apply for the name first before the actual incorporation filing. The VCC name application costs 15 Singapore dollars. There'll be a suffix of the VCC entity and adding to your VCC. And after that, you get all the documentation ready as far as the constitution is concerned. The constitution has to be lodged with the ACRA, the company registrar, and not the regulator, MAS. You don't have to go to MAS to launch a VCC unless it's meant for the retail public. For all alternate fund products such as hedge fund, private equity, real estate, the process only involves incorporation and go to the ACRA. Then you decide on the directors, the company secretary, the local address. The ACRA will take in the application form. The registration fee is 8,000 Singapore dollars. And if you are launching the umbrella fund, and for each additional sub-fund, you only need to pay 400 Singapore dollars. And within 14 days, the ACRA will respond with the certificate of incorporation. And that is a lot faster than other jurisdictions. Next slide. Redomiciliation. Number one, fund must meet the definition of a collective investment scheme of Singapore, which is a normal investment fund. And wherever you redomicile, it must be a body corporate and not a foreign limited partnership or foreign unit trust. And it must be of the same structure. Cannot be an umbrella fund in Cayman and then you redom into a sub-fund in Singapore. And one of the questions I got yesterday is, if you decide to redom your existing fund from overseas to Singapore, you can take the history and the performance with you. Therefore, it's not a breakup and you got to start everything afresh. You can take all those performance with you to Singapore. And number 3, most importantly, from where you redomicile, you must find a country that allows outward redomiciliation provision. And in most jurisdictions like the Cayman, BVI, Mauritius, they allow outward redomiciliation. Number 3, you can also consider setting up a sub-fund under an existing umbrella, under Raffles Family Office umbrella, for instance. So there will be, number 1, there will be a meeting with all the parties involved in the VCC ecosystem. And today is a form of con call or the Zoom meeting. such as the fund lawyer, fund admin, if required, for us to better understand the structure and the setup of the VCC sub-fund. And in order for them to draft and prepare the legal documents. After that, you have to complete our DDQ and for our compliance team review. As part of our AML and KYC requirement, we need to DD the investors as well. Number 3, once we have the above steps agreed and completed, letter of engagements will be issued and signed between us and the professional parties involved. We will then provide an MOU to be signed and the payment of initial deposit as well. So now I've come to the end of my presentation. To summarize, firstly, I took a step back and started with the diagnosis and analyzed what were the challenges of existing fund vehicles in Singapore. Then how VCC can overcome those limitations and come up with the solutions. Then I did an apple-to-apple comparison between Singapore VCC and Cayman SPC and found out that structurally, VCC is not something new. And as a matter of fact, it exists in other jurisdictions as well, such as the CCAF in Luxembourg. And CCAF in English, it's actually a short form of a French word, but in English, it means investment companies with variable capital, which is more or less the same as variable capital company. As well as we have the SPC in the Cayman, as described, and the OFC in Hong Kong. Therefore, this is not a new vehicle. And although Singapore is a bit late to the game, but having said that, I believe that this is an advantage because we can use the lesson learned by those markets to create a competitive advantage for Singapore. And also, a lot of actions are happening in this part of the world and in Asia. Singapore is very well positioned. MAS and the ACRA has spent a few years to develop this and put a lot of thoughts into it. So I believe that this will take Singapore to the next level. This is it.